Good morning, everybody. My name is Melvin Escudero. I am the chairman of the Council of Advocacy for the Latam and Caribbean region at the CFA Institute. It's for me a pleasure again to welcome you to this webinar that is integrating the effort of 13 societies in our region. I want to thank you the work and collaboration of the societies CFA Society Brazil, CFA Society Mexico, CFA Society Argentina, CFA Society Chile, CFA Society Colombia, CFA Society Uruguay, CFA Society Jamaica, CFA Society Bermuda, CFA Society Barbados, CFA Society Trinidad and Tobago, CFA Society Cayman Island, and CFA Society Bahamas, that only with CFA Society Peru, we are producing in a monthly basis different types of webinars with the outstanding issues that are surrounding our industry, especially the asset management industry. So welcome to all our members in the region, and we hope that this webinar will be at the highest level on the ESG discussion. As you know, the ESG is a big trend, and CFA Institute is also promoting a new exam that was launched a few months ago, last year, and that is globally right now accepted by different countries like a new standard. So we are also hoping that in our region, many companies has been adopting the ESG standards. At the stock exchanges, most of the listed companies, especially the multi-Latinas companies and the global companies that cross-list in our countries, they are leading this trend in our region. But there is a big challenges to do on the list for the next years. And probably the region is not necessarily at this moment at the level of advance, like in Europe, for example, who is probably the region more advanced on ESG. But we believe that it's just a matter of time. And what we are doing with this type of webinars is contributing on these discussions to present different cases, different point of views, different proposals, and also different alternatives of solutions to our challenges. So we have today a very interesting agenda. We will start with an overview of the ESG practices in Latam and the Caribbean, presented by Eduardo Atehortua, who is the head of Latam, or the Principal for Responsible Investment, PRI. After his presentation, we will have a panel with 4 specialists that has experience in different markets globally. And finally, we will have also the final closing words from Inigo Bencochea from the CFA Institute. So to start straightforward, I invite Eduardo Atehortua from PRI to start with his keynote presentation. Go ahead, Eduardo. Thank you very much for being with us.
Thank you, Melvin, and really happy to be in this webinar today. For sure, we are experiencing, I think, a critical moment for what's going to be the evolution and next steps for ESG and responsible investment. So I think it's really good that the CFA Society and in these multiple countries in Latin America are giving us the opportunity to talk about this. So thanks a lot for the invitation. So in my 10-15 minutes, I will talk a little bit about, I will say mainly 2 things. I want to share some insights about how the concept of responsible investment is evolving globally and how that connect with what we are seeing supporting PRI signatories in Latin America. And the second message that I want to provide today is about how responsible investment is evolving in Latin America. I agree with Melvin. We are not in any way close to how responsible investment is approaching Europe. We have decades to reach to that level. But I think it's important to mention that at least in 5 countries in the region, Brazil, Chile, Mexico, Colombia, and Peru, we are seeing a lot of important evolutions in the last 4 years. And in Brazil, even more time, but we are seeing a lot of evolution. And I also want to share that information with you in a way, what I'm trying to say is that responsible investment and the integration on ESG information in Latin America, at least in those 5 countries, is already happening. It's not a trend. It's something that is here to stay. I will explain why I think that in a few minutes. And for sure, we need to prepare. So I think the CFA societies are going to play a very important role to help us, having more people in the financial industry in the region, understanding this topic, and obviously applying this in their day-to-day analysis and investment decisions. So for the first part of my intervention, I want to share a little bit about the evolution of responsible investment. And PRI recently make a review of their strategy, and we launched a new strategy for 2021 through 2024. And what we are trying to showcase in this new strategy is that the concept of responsible investment is evolving. And PRI, that is an investment association with more than 5,000 signatories, is also evolving. Just to give you a reference, when I joined PRI in June 2018, we have less than 2,000 signatories globally. So a lot of things have changed in the last 4 years, and PRI also need to adapt and evolve because of this. So I just want to say that what we are seeing today, working with the signatories that we advise and we support, is that there are 2 big trends or 2 big definitions of responsible investment. One is more focused on inputs, and the other one is more focused on outcomes. So the majority of signatories of PRI globally and also in Latin America are more focused on the input side of the approach to responsible investment. That means that every time that a signatory, that an investor is looking to apply a responsible investment strategy, what it's really doing is understanding and analyzing environmental, social, and governance factors, ESG factors, that could be financially material to the companies or the projects that they are investing, either on public markets or private markets. What they are doing is integrating ESG topics into their investment decisions. And the main objective is to maximize results and minimize risk. So this is not different from what investors have been doing in the past. They need to comply with the fiduciary duty of maximizing results for clients. But investors now understand that there are environmental, social, and governance topics that could have an influence on how companies operate now and in the future. And because of that, they need to integrate that information into their investment decisions. So that's one approach, and it's more about inputs. And then we have an approach that is getting a lot of momentum. I will say, especially in Europe, it's happening around the world now, but it starts in Europe, mainly in the Nordics region, and now it's expanding. And what we are seeing is that because of all the challenges that we are facing right now in society, and this is a reality, and sadly, this is something that is also happening, and it's really, we can see this in Latin America. So many sustainability challenges that we are facing. Now investors are asking the question about, okay, how my investments are not only going to create a financial return, but also can create a positive sustainability outcome. How we can, through our investments, can help solve some of these challenges that we are facing. So those are the 2 definitions that we are seeing right now. And I think it's important for you to know that that's the reality of how investors are approaching responsible investment globally. Just to give you some, and this is, some general statistics, but I can tell you from experience, from the signatories that we support in Latin America, I will say 95% of them are looking at responsible investment from the input side, and just 5% of them are trying to move through this bridge and trying to go to the real world sustainability outcome. So the majority of signatories, at least in Latin America, are looking at responsible investment from the input side. And I will say globally, it's not maybe 95%, but something around 80-85% for sure. Investors are looking at responsible investment from the input side. So I think that's important, and I'm sure that in the panel that we are going to have next, there is going to be plenty of views and experiences about how their organizations are looking at responsible investment from the input or from the outcome side. So that's the first part of my presentation. This definition and these two main views of responsible investment. Now, let me talk a little bit about what's happening in Latin America. So let me start by saying that we at PRI, since 2018, we decided to change our strategy, change our approach to the region. Since 2010, we were mainly or almost only focused in Brazil. And in 2017, 2018, we decided to make a change in the strategy and we separate the operations. So now we have somebody, my colleague Marcelo, that is in charge of PRI operations in Brazil. And since 2018, I have the opportunity to support the evolution and the expansion of PRI in what we call Spanish-speaking Latin America, or Latam excluding Brazil. So as I was mentioning before, we are seeing a big expansion and a big increase of interest from investors in the region to align with better global practices on responsible investment. That, I will say, to summarize what PRI offers, is that we offer a pathway, a roadmap to implement better practices on responsible investment, better global practices on responsible investment. So with the strategy that we are deploying, what we are seeing, as I mentioned before, is a big interest, especially in four markets: Mexico, Chile, Colombia, and Peru. We are advising right now more than 120 funds in Latin America, either asset owners, asset managers, and we have also something called service providers. But from those organizations, 85% of them are based either in Mexico, Colombia, Chile, and Peru. And I know, and especially knowing the people that are joining this session today, you know why these four markets are the key ones for us. And I don't think this is going to change a lot in coming years. I think we are going to be 80-85% in these four markets, and we are going to try to continue, looking to expand to other markets. But it's not easy, because for us, for example, one of the main drivers of PRI expansion in these four countries has been, the private pension funds. They, as long-term investors, have been really critical and really supportive of PRI work. And we know that besides maybe Uruguay, Dominican Republic, and other countries, we don't have this option of interacting and working with private pension funds in the region. So I think that's important to consider. And this is not the space to talk about the future of the private pension funds. We know that there is a lot of challenges for them, but at the same time, at least from the PRI perspective and the work that we are doing promoting responsible investment in Latin America, private pension funds have been very important allies for the expansion of responsible investment in the region. And then I also want to mention, I say that we are seeing 5 countries that this is happening, and that in the next, I would say 3 to 5 years, this is a reality. So I know that we have challenges and there is criticism about ESG globally. I don't see so much criticism locally. Globally, for sure, in the US, in Europe, not so much here. Maybe that's going to change in coming months or coming years. But what I'm trying to say here is that because of the new regulation that is now in place, this is going to happen. And just let me give you an example. my conversations with many of the investors that we support through PRI is not more, they are not asking me to motivate them or try to give them reasons to incorporate ESG information into their investment decision. That's not the conversation now. The conversation is about how to do this and how to comply with the regulations that are now in place, and how to, try to just use the regulation as a baseline and try to move, forward and do more things. So at least in countries like Chile, like Mexico, like Colombia, because of regulations, the conversation is completely different. What the investors are asking us is support through training and to give them access to case studies and tools and access to ESG data so they can incorporate that in their investment decision. So I think that's happening, again, more from the input side, from the integration of ESG either on public or private market investments. And I think this trend, because of regulation, is not going to stop. Another important thing to mention, these regulations are really new. In Mexico and Chile, these regulations started last year. We are going to see the implementation this year. And in Mexico, the regulation started in January 2022. So this is quite new. And in the next 3 or 5 years, we're going to see, the impact and the transformation that this regulation is going to create. I just want to say, again, thanks to all the organizations that decide to join PRI in the last 4 years in the region. I have to say, and I'm really proud to say this, Latam, excluding Brazil, has been the faster, the region that is increasing their rate of signatories faster in the world and faster in the emerging markets. So that for us is really good. And I think it showcased that this is happening now in Latin America. Again, not in all the countries, but it's happening now in some strategic countries. And we hope that this momentum continue and that we can, get to a new level of evolution of responsible investment in the region. Just to wrap up, and again, thanks for the invitation. Let me finish with some challenges. And you can read this here, so I'm not going to read this, but I want to emphasize on the one that you see in red, greenwashing. That's a big challenge, for sure. A big part of the criticisms that ESG is getting globally is because of greenwashing. So what we are doing right now with all these organizations that we are supporting in Latin America is helping them, developing the capabilities, getting access to the tools and the methodologies that will allow them to do this in a correct way. And we can, reduce the chance that they will, make some claims or make some, or give some information that can, be perceived as greenwashing. So it's not easy, but I think it's possible, and we can learn from the lessons from other markets. And with that, we can use that. So greenwashing is not a big challenge in the region. So that's from my side. Again, really happy to have the chance to make this presentation today, and more than happy to continue this conversation with people that join this webinar that want to learn more, either about PRI work in the region or about the evolution of responsible investment in Latin America. Melvin, thanks a lot for the invitation.
Thank you to you, Eduardo. Very interesting review of where are different countries right now on ESG implementing processes. Like you mentioned, this is a big challenge. I hope that it will not take 20 years to be at the level of Europe, but I believe that the changes are going very fast, actually, so probably it will be faster than that. Thank you, Eduardo, again for your collaboration and participation in this webinar. Now we are going to our panel. For that, we have with us José Larrabiur, who is a board member of the CFA Society Peru. He will be the moderator of this panel called ESG Investment Outlook, Risks and Opportunities. Welcome, Jose, and thank you for being here. Go ahead, please.
Thank you, Melvin. Thank you all for joining us today. We will start the panel with a presentation of Maria Sanchez. Maria is a director at the ESG Index Product Strategy at Latin America for Standard & Poor's Dow Jones Indices. In her role, she collaborates in the development strategy of ESG indices for the Latin American market. She joined S&P Dow Jones Index in 2015 as an associate director of global research and design, where she was in charge of the conceptualization and design of new indices. Before joining S&P Dow Jones, she worked as a portfolio manager and operator of insurance mandates and private pension funds at HSBC Global Asset Management in Mexico. She also held various positions at ING Bank Mexico, including management functions for structured products, market risk, and money market. Please, Maria, thank you for helping us today.
Thank you very much, Jose. I'm sharing my screen. Can you see it well now?
Yes.
Thank you very much. So today I'm going to talk about ESG through the lens of an index provider. No? So S&P Dow Jones Indices is a division of S&P Global. And what we are doing here is to develop and offer indices and benchmarks to measure the performance of different markets. No? So as index providers, we are part of the financial market ecosystem, and we try to provide this transparency to the financial markets through our information. No? So whether there's an investor, market participant that is looking to track the market performance or evaluate their portfolios, well, we provide this kind of indices, these indices in general, to complete this ecosystem. No? Now, as an index provider, we don't manage money. We are not asset managers. However, our indices are licensed by asset managers, no, in order to offer financial products. And these providers develop index-based funds. It can be also insurance products. It can be structured products as well. So what we have seen through the last years is that the ESG strategies that have products linked to them, they have been evolving, no? Especially for example, our franchise around the 500 ESG indices. And this is very important because this is one of the main drivers to accelerate ESG adoption. No? I mean, the scale. No, the scale is very important to drive this conversation with the different companies. So what's driving this change? No, what's driving this adoption of ESG criteria? So one of the things can be the pressure from investors and stakeholders, such as employees, customers, as Eduardo said, also regulation, environment. All these things are creating this environment to accelerate the adoption of ESG integration in the processes. And the reporting companies as well, no? So they have been improving across the world, and I've seen that directly in Latin America, and that's leading to more transparency and on this data, on the inputs that we are using to create the ESG indices. No, we are not new in these kinds of indices. Actually, we have more than 20 years of experience. So that's not ESG itself. It's not that new, no? With the S&P Dow Jones Sustainability Index, we started in 1999. And in that moment, the idea was especially recognition and engagement with the companies, and not necessarily to keep a low tracking error versus the universe, no? And the thing has been evolved, and what we have been doing is incorporating our indices that evolution, no? So we started also incorporating new asset classes like the green bonds, and there the new, for example, the new trend of trying to reduce tracking error or keep the performance or the characteristics of the base index into the index construction of the ESG versions, and also climate focus indices. No, so we are trying to evolve with these new standards with the market. The methodologies are evolving, even for those indices that are already launched. We have these kind of mechanisms to incorporate new standards into the index constructions. So what we have right now, for example, in this evolution is we have this philosophy as an independent index provider to offer like a wide number of indices in order to provide our clients, the market participants, a choice, no, on different topics or conviction levels. So our indices go, we can group them in 4 different groups. One of them is the core. In this one, we have best-in-class strategies such as the Dow Jones Sustainability Indices that I mentioned before. We have also ESG indices and more sophisticated ones like leaders and elite, or more with more high-level conviction. We have also this suite of climate that we are trying. First, we were trying to reduce just carbon, and then we were incorporating the rules of the European Union indices. So we have packed in this Paris Aligned and climate transition indices as well, and also fossil fuel free indices, again, to have different alternatives for our different clients. No? And thematic indices, this is more focused, like it's more like for a kind of boutique kind of provider of asset manager, for example, that they are related to very specific ESG issues, including global water or, for example, clean energy. And well, in terms of asset classes, fixed income, it's also one that it's gaining more attraction, especially in these days of high inflation and also high rates. No? And I'm going to focus here a little bit on what we have again in the core indices. And I think this is very important because as I mentioned before, the scale, it's one of the main drivers of the incorporation of ESG in the portfolios. No? So what we have seen is that there are different levels of conviction. However, in our methodologies, what we are trying to do is try to reduce the active exposure on trying to have sector neutrality, or in some cases also industry group neutrality. These kind of indices are weighted by float market cap, and what we are doing is just being or more or less strict in the inclusion criteria, in the eligibility criteria in terms of product involvement, and also what is the percentage of float market cap that we are targeting. No? So what we have seen in our indices is that even when we are trying to keep low tracking error versus the S&P 500 in this case, for example, while we are more strict in the inclusion criteria, the tracking error is a little bit higher. No? So they are trade-offs, and all of them still, even the most constrained index, that it's the ESG Elite Index, it has a manageable tracking error around 3. So what's our approach in Latin America? So over the years, S&P Dow Jones Indices, we have partnerships with the main exchanges around the region. We have jointly launched equity indices, and in some of them fixed income indices, and we have recently introduced ESG indices in the region. No? So there are different purposes, some of them still for recognition purposes. Remember, with these joint efforts with the exchanges, we have like two kind of clients. No? The exchange itself trying trying to support companies and provoke them to incorporate ESG criteria and be better in the ESG scores. And on the other hand, also serve the market participants in order to have investable benchmarks. No, so in some of the regions, even when you are small countries, we have more than one index to serve those different purposes: engagement and replicability. So, well, as Eduardo said, this is a world that is changing every day. This world is getting more complex by hour. So we try to collect this data and combine it with different ways in order to connect to our partners with intelligence that they need to make the decisions with conviction. So I invite you to help us and create solutions together and complete this ecosystem where indices are a very important part of. No? So I think I'm just in time. Thank you again for the invitation, Jose, and I give the word back to you.
Thank you, Maria. Very interesting information. I will now introduce Christopher Fiedler. He's the head of product management at the CFA Institute. Chris holds a Bachelor of Science degree in engineering from the University of Illinois and a master's in business administration from the Darden School of Business at University of Virginia. He led the promotion of CFA Institute industry codes and standards globally and helped to identify areas where new standards were needed. Prior to joining CFA Institute, Mr. Fiedler was a management consultant at Thought Logic Consulting LLC and served in several management roles at Capital One Financial Corporation. Chris, thank you for joining us.
Thank you, Jose. It's a real pleasure to be part of the panel today. And I would like to pick up where Eduardo left off and talk about greenwashing. And in particular, I'd like to talk about the global ESG disclosure standards for investment products, which are standards that will help managers who offer funds and strategies to avoid accusations of greenwashing. Now, greenwashing is a word that I think gets thrown around a lot, and I think we need to do more to define what we mean by greenwashing and identify the particular practices that lead to allegations, and think hard about what we need to do as a profession and an industry to mitigate greenwashing. So I'd like to start by sharing some examples from the Australian regulator of situations that they characterize as potential greenwashing. First, an issuer's disclosure states that it considers, integrates, or takes into account sustainability-related factors when assessing new and existing investments, but doesn't explain how. And for clarity, we're talking about an issuer of funds and strategies here, not an issuer of stocks or bonds. Second, on its website and various social media platforms, an issuer claims that it is committed to making investments that contribute towards positive impacts for its investors and the world. However, the issuer does not disclose what it considers to be positive impacts for its investors of the world and how its investments contribute to those stated outcomes. And last, on its website, an issuer states that when making investment decisions, the issuer's investment managers will focus on sustainability-related factors that have a material financial impact on the investment. But the issuer doesn't clarify how it defines that concept of material financial impact. Now, you've probably all seen such language like this and might already recognize the problems here. All the statements here are making pretty high level, general, vague claims, but they're not backing up those claims with specific information. So that's one of the big problems of greenwashing, one of the main causes of greenwashing. It's exaggerated, unsubstantiated, or misleading names or claims. It's overly generalized, ambiguous, vague terminology and disclosures. It's missing or incomplete information. It's inconsistencies between marketing material and statutory disclosures and annual reporting. and it's a lack of comparability among different funds and strategies. Those are the main problems that contribute to greenwashing. So what can we do as the industry to combat greenwashing? I think it's a three-step process. First, we need to acknowledge and agree that managers of funds and strategies need to disclose additional information when they incorporate ESG factors into the investment process or stewardship activities. And for that, CFA Institute offers the Code of Ethics and Standards of Professional Conduct and the Asset Manager Code. And if you're a CFA charter holder, you already commit to disclosing the key significant factors that go into the investment strategy to clients and prospective clients. And if you adhere to our Asset Manager Code, you already agree. And frankly, the people I talk to, just about everyone agrees that managers do have a duty to disclose more information when they are holding out ESG-focused funds and strategies. So not a lot of debate there, honestly. But now we get to the second step, and that is reasonable people could disagree about the type of information that should be disclosed, the level of detail, and where it should be disclosed. And for that, we need standards. We need to have an agreement about the type of information, the level of detail that should be disclosed. And that is exactly what the global ESG disclosure standards for investment products do at a global level. Now, regulators are also setting standards within their laws and regulations. We'll talk a little bit more about that in a moment. And finally, the last thing we need to do is, as an industry and profession, is develop the skills, the written communication skills to speak with accuracy, clarity, and precision about how ESG approaches are used in a fund or strategy. And for that, CFA Institute offers a certificate in ESG investing to give people a broad understanding of ESG factors and the different approaches that are used in funds and strategies. And we offer technical materials and training to help people comply with the standards that I've just mentioned. Now, before going on, people often, when I talk about codes and standards, will say, there's so many codes and standards that we have to deal with, it's so confusing. So I want to give you a brief overview of the landscape of ESG codes and standards and where these fit in. So the global ESG disclosure standards for investment products are standards for funds and strategies for how to disclose essentially their ESG strategies that they use within the fund or strategy. There were some other voluntary standards out there prior to these. And I think in some ways, these global standards have consolidated those because those previous efforts were designed for particular regions, particular ESG approaches, or particular asset classes. We'll talk a little bit more about that and how we've consolidated that in a minute as well. If you were looking for standards for how corporations should disclose and report on ESG issues, you would not look to these standards. You would look to ISSB, which is the International Sustainability Standards Board, and GRI. The ISSB has incorporated SASB and other bodies, so we're seeing consolidation of standards there as well. If you're looking for how managers or asset owners should report across their entire organization, you might look to the PRI reporting framework or to TCFD. Also, the ESG disclosure standards are not minimum standards for designer performance. If you were looking for something like that, a minimum standards for how a product should be labeled or how it could be certified, there's about a dozen different programs around the world for minimum standards of designer performance. And finally, our standards are not terminology or classification. Again, around the world, there's various different systems for defining ESG terminology and classification. Frankly, that's an area that needs particular work, and that is something that CFA Institute and others are going to try and bring some more global consolidation to in the future there as well. Now, if you open the ESG disclosure standards, I want to give you a very brief overview of what you'll find, and I just want to focus on one particular section today, and that is the investment product disclosures. And the disclosures really come in three different categories. The first is summary level disclosures about the ESG approaches used in the investment product, and that would cover just a summary statement about whether you're using, for example, ESG integration or screening or impact investing or best in class, as well as a summary description of any specific ESG issues that the product is focused on. For example, climate, gender diversity, water, etc. Second, there's disclosures related to the sources and type of information, essentially the inputs that are being used in the strategy. Where does that information come from? What type of information is it? What sort of risks and limitations might there be in the funds or strategies use of that information? And finally, there's disclosures required for each specific approach that's used. And I would say that these 7 approaches you see here actually represent the full universe of all approaches that any fund or strategy would use. All funds and strategies are a combination of one or more of these approaches with their parameters tailored in different ways to create different sorts of products for different sorts of people. And one thing I'll point out here, I'll just go back to Maria's presentation because she was talking about indices. And there's disclosures in here about whether or not a fund uses an ESG index as its investment universe. And these disclosures would require the manager to give investors some more information about where they can find information about that index and its construction methodology, so they can understand the sorts of trade-offs that Maria was talking about earlier. Now, as I mentioned earlier, the standards are universally applicable, and that is one of the things that we've heard from managers as one of the key benefits that they see with these standards is they can use one single standard globally to understand the sorts of information that they should be providing in their disclosures and marketing material. So we've designed these standards to be universally applicable, regardless of the ESG approaches the manager is using, regardless of how the investment strategy is packaged, be it in a fund, a mutual fund, or a trust, or an ETF, or a strategy by which individually accounts are managed, or even partnerships. We've designed them to be applicable to all asset classes and to be used in all markets. And on that last point, I want to dive a little bit deeper because one of the main questions that people ask us are, how do these standards interface with local regulations? Because we have seen regulators around the world make ESG disclosures a priority. We've seen it in Europe, we've seen it in Hong Kong, we've seen it in Singapore, and as I learned earlier today from Eduardo, we're seeing it in Latin America as well. And I would say that there are a couple of two actually really distinct benefits for having global standards in addition to regulation. First is global standards can help harmonize regulatory expectations around the world. Frankly, regulators are primarily concerned with their markets and what's going on in their markets, and they write rules that are specific to their markets. And when that happens, often you don't get harmonization globally. So there needs to be sort of a North Star, if you will, that helps regulators guide them towards more consistency. And we offer these standards as a model, if you will, of the sort of information and the sort of detail that should be disclosed. And we welcome regulators to use these as a model and use it as an input to their rulemaking. And if any of you work in markets where the regulators are actively making rules, I would hope that you would make them aware of our standards, encourage them to use them, and direct them to us if they have technical questions about those requirements. And secondly, for managers, these standards can aid the preparation of the regulatory disclosures. Let me give you an example. Sometimes regulations can be quite broad and vague. Some regulations say things like, the manager must disclose the ESG strategies they use. Now, that's simply setting an expectation, as I said earlier, that it should be disclosed, but it gives managers no guidance about exactly what sort of information is important to investors, what level of detail, and how to avoid greenwashing. So when regulatory requirements are high level or vague, these standards can help managers decide what to put into their regulatory disclosures. Let me conclude with the benefits, because standardization of information benefits both buyers and sellers of investment funds and strategies. For buyers, which we include as end investors, consultants, distributors. It helps them better understand and evaluate and compare the ESG approaches used in different funds and strategies. And having a better understanding makes their processes more efficient. It makes it easier to do manager searches, product selection, due diligence, governance reporting, and record keeping. And for investment managers, it can really help too. First and foremost, it can be a way to help investors better understand what you're offering. Because if investors are confused, they're not going to invest in your fund or strategy. So it's very important to explain to your target investor how you've incorporated ESG approaches. Second, again, standardization can save time and effort. A lot of managers are having to respond to different requirements in different jurisdictions, respond to customized requests from different sorts of clients. If managers can take ownership of that through these standards and say, we've produced this information in a standardized format for you. We will certainly answer all your questions, from your due diligence, but let me give you this as a standardized way of communicating how we look at ESG factors in this fund or strategy. It can help managers reduce legal and compliance risk, and I think we talked about that already, about how it can help managers with their regulatory disclosures. In writing down in a written format how you've done this, it can help you identify problems before you get into a regulatory exam and regulators are asking those questions. So if you will, it's a good way to test your understanding and your communication of your ESG strategies. And last, adopting voluntary global standards is a good way to enhance your brand as a manager. It really shows that you are putting your client's interests first. It shows that you care about market integrity and you're willing to provide the information that investors and consumers need to make informed decisions about their financial health and future. So with that, I will wrap up the presentation and hand it back to you, Jose. Thanks very much.
Thank you, Chris. Very interesting presentation. Now we'll jump to Alison Eskesen presentation. Alison is a Managing Director of Strategy and Impact Investment at the Community Investment Management. She received a Bachelor in Administration and a Bachelor degree in Economics and Political Science from Colgate University and an MA in International Affairs from Columbia University. Prior to joining SIM, she led the MasterCard Center for Inclusive Growth in Asia Pacific, where she built the regional philanthropic portfolio focused on small business growth, gig worker skilling, and health infrastructure. She has a significant industry and international development experience in expanding market connections, digitalization, and access to financing. Thank you, Alison.
Thank you so much, and thank everyone for being here. I'm really excited to be able to speak with all of you today. So let me start by just explaining who is Community Investment Management, and then I'll jump into my presentation and really build on what the other presenters have already said. So CIM, Community Investment Management, we are an institutional impact investor. We provide private debt to fintechs that are offering responsible credit products in underserved communities, because our ultimate ambition is how do we help cultivate and create an inclusive financial system, and doing that at scale, which for us inherently means that there has to be risk-adjusted returns in order to get that scale in a meaningful, transformative level. And since our conversation today is around ESG opportunities and risks, I thought I'd actually start with just some takeaway messages, things that I think are important for the audience to remember. So, whoops, let me see here if I can actually do this. So we'll start with the first one. So takeaway number 5, ESG does lead to greater returns. So there have been numerous studies, greater than 2,000 according to this research, that shows that there's a positive relationship between ESG propositions and returns. I think that one of the things that's important and plays out differently in my partners or panelists' presentations is that we see ESG as really around risk mitigation. So looking at the environmental, social, and governance aspects that can affect a business's longevity, can affect their success in their community, their license to operate, can affect the strength of their governance principles and their ability to reduce corruption, to respond to investors. And so those ESG risks we think are incredibly important when we're looking to invest, because at the end of the day, we want to see companies be successful. And we believe that if you don't have ESG being integrated into the way that you operate, that you run a greater risk. To that end, now takeaway number 4 is demand is high for ESG products. I think this was Morningstar that had estimated in 2021 that their Q1 demand for products was as high as the first 2 quarters in 2020. If you actually look what happened in 2021, JP Morgan said that it was actually 500 billion that flowed into ESG. So there is incredible demand. I think that there's a growing realization among consumers, among investors, among regulators, and then among corporate leaders as well, that ESG makes business sense and that it's not necessarily an add-on that doesn't have to be that. And that's despite a lot of the controversy that's been raised around whether or not ESG is somehow displacing shareholder or fiduciary responsibility. I think to the contrary, that considering ESG and how you run your business and considering ESG policies, practices, and actions is actually part and parcel of a fiduciary responsibility. So takeaway number 3, ESG is institutional. We heard already from Eduardo around PRI and sort of the growing demand. This is just really showing that assets under management have significantly increased year on year, and that this isn't a trend that seems to be going away. It's no longer easy to dismiss it and say it's simply a fad. Rather, there's been this tidal wave of movement to say that ESG is critically important as another way in which to assess a business opportunity. So takeaway number 2, which I think I'd started earlier, so maybe I've already usurped this takeaway, that we believe ESG is about risk management, that the world is changing, and as a result, the factors that you need to consider to understand whether a business is a good long-term investment are also changing. So you need to think about how will climate change factors or environment affect the ability to source goods, that will affect your supply chain, will affect your own ability to operate a factory in a particular location. There's been a sort of global movement repudiating inequality. And what does that look like? And how do your stakeholders feel about that? From your customers to your investors, including your staff. How do they feel about this? And what do they expect from a company in terms of a position on this? There's clearly a new generation with different priorities that are coming in and influencing the demand for ESG. And that can be everything from sort of young investors who are high net worth to just consumers saying that they're willing to put their money where their values are. And also, again, which I've mentioned before, we think it's important around long-term business planning, that it is hard to think about the sustainability of a company, the strength of a company over even the medium term without thinking about environmental, social, and governance risks, and putting in place actions and policies and practices early on to be able to mitigate those, to anticipate those, and to rectify those challenges. And certainly the role of technology and digitization in many ways have made ESG easier, easier to understand, easier to report, in some ways easier to address. But then also the one piece that's not there is this idea of universally accepted or universally applicable indicators. And so that's actually where I want to land in terms of my last takeaway for all of you, is that ESG, we believe, is tip of the spear, that as more and more this becomes mainstream, what we believe that is on the horizon next is this focus on impact. And impact we would define as intentional, usually positive, but intentional positive change on a group of stakeholders that are important to you. And that ESG as a risk mitigation is an important first step, but that we will soon see that, that train move toward how do you actually measure impact? What does that actually look like? And what we believe is important for investors, for fund managers, for corporations, for even small startups to think about is how do you create systemic transformational change, which we would define as altering business as usual, finding ways that are organic, that are intrinsic to the way you operate, that could also be impactful on either a social or environmental way, and start to think about how you're adjusting your BAU to be able to create that positive impact as well. And we see that that is something that more and more founders that we work with care about. And as they start to think about that, we also believe that it's important to measure change beyond just the risk mitigation, but start to measure the positive change. And in order to do that, there needs to be a clearly stated ambition, actions, results, and verification. And underlying all of that is simply collaboration with partners. That at the end of the day, it is very difficult to move on that bridge that Eduardo had presented in the beginning from inputs, I think is the way he described it, all the way through to outcomes. And that to move along that bridge, we're going to need to do it together. And we think that there's lots of ways in which that can be achieved. And so I thought I would conclude by just sharing with you, how does CIM think about impact? Think about ESG as well, but also think about impact. And so what we've done is we've created a number of tools that we use internally to assess ESG risk factors and to understand what sort of mitigations are put in place before we do an investment. But then also during the sourcing and due diligence process to actually score prospective investees against a prioritized impact criteria that fueled our own impact thesis. And we do this so that we understand how do fintechs, which is who we invest in, offer or roll out products that are aligned and advance global standards that define responsible investing. And we think, similar to all the other panelists, that it is incredibly important to have this comparability and that the global standards do add incredible value and simplicity to this process. And perhaps more importantly, it helps us to anchor within our own firm that there's sufficient rigor, there's sufficient consistency across investment officers, and that we're all singing from the same songbook. And so we have this impact scorecard that we've created that we use during the sourcing and due diligence process. As we use this, what we're finding is that we are able to have our own benchmark data. So within CIM, when we think about an investment, where does a prospective investee fall against other existing partners? And so that has been a very useful tool for us as we become more sophisticated in our own approach. We also, as I mentioned earlier, do an ESG assessment. Our partners tend to be early stage fintechs. And so a lot of the ESG indicators may not necessarily be relevant given the stage of maturity that our partners or prospective partners are in. And so we've really identified material ones that we think are critical for operations, critical for governance, but then also ones that when a fintech takes our debt facility, grows their portfolio, expands their penetration into a market, and goes for their next capital raise, we also want to prepare them and help them be in a position that they have the right ESG policies and actions in place so that they are more attractive to a more sophisticated equity investor. And this is all part of our journey to really help grow fintechs to be as successful as possible, because we only invest in fintechs that are offering responsible credit products in underserved communities. And when they do that, we believe that there is both a copycat effect and a mainstreaming effect that occurs, that if you're commercially successful and you're offering these responsible products in underserved communities, it really catalyzes others to follow suit. And that, over time, helps to create a more inclusive financial system that really works for everyone. And then so in addition to the impact scorecard and the ESG assessment that we do as through our due diligence process, we also build really strong collaborative relationships with our partners, because ultimately we want to have soft influence. We're an institutional debt provider, so we don't take ownership, but we do believe that as an all-in partner, we have very aligned goals with our partners, and we want to help them grow. And so we provide technical assistance that can vary from go-to-market strategies, product refinement, impact measurement, and all the way through to helping with introductions to capital raise. And all of this is because at the end of the day, our success and our ability to accelerate and achieve our own impact thesis builds on the collaboration and the success of our partners, because when they grow and offer more responsible credit products in underserved communities, it benefits people and small businesses who have historically been marginalized or excluded from financial systems. And that is what we are trying to transform. And with that, I think I'll stop just to allow some time for Q&A.
Thank you, Alison. Now we jump into our final presentation of the panel. Let me introduce Stephen Thomas. He's a principal officer for financial institutions at the IDB Invest. He earned a master's degree in business administration from McDonough School of Business at Georgetown University and an undergraduate degree in economics from the University of West Indies. Before joining the IDB group, he led teams focused on equity brokerage, investment advisory, and wealth management for an indigenous banking group in the Southern and Eastern Caribbean. Prior to that, he led the debt capital market division in the Caribbean for one of the largest global banks, covering both public and private clients across various sectors. Thank you, Stephen, for joining us.
Thank you very much, Jose. I trust you can hear me quite well. I'll share my screen in the meantime with everyone concerned so that they can follow. But thank you very much to CFA Institute for having this session, and good morning to my fellow panelists and everyone joining in. I'd like to start by mentioning a couple of things and just giving a backdrop as to who the IDB Invest is and the organization which I represent. As some of you may know, the IDB Invest is the private sector arm of the Inter-American Development Bank Group, a multilateral development bank that's positioned in Latin America and the Caribbean to drive commitment to economic development amongst its member countries. And it fulfills this purpose by financing sustainable companies and projects so that it can achieve financial results that maximize the region's economic, social, and environmental development. Alongside, my apologies. So alongside other multilateral institutions, as well as other market participants, we all play a significant role in promoting the advancement of the sustainable market by catalyzing institutional investment and enhancing private sector participation. Evidence of that fact is, and Eduardo would have mentioned this earlier in his presentation, is the number of signatories that we have seen throughout the region that have signed on to the principles of responsible investments. What's interesting is that the number of signatories has jumped fourfold in the last 3 years to December 2021, even during the pandemic period. And correspondingly, this has led to the growth in the volume and value of thematic bonds across America, where issuances have crossed. Much of this activity has taken place outside the Caribbean region, which is at the forefront of the challenges, or many of the challenges associated with ESG. As most of you would be aware, the world faces an uncertain future, which is characterized by environmental and social risks, coupled with inadequate governance, threats to unstable economic growth, as many of us would know it. Climate action failure, biodiversity loss, involuntary migration, and infectious diseases have all been just a few of the risks that governments, society, and businesses have commonly cited as impediments to sustainable and inclusive long-term economic growth. Overcoming these challenges will require trillions of dollars, and according to the UN Sustainable Development Goals, one estimate is as much as $2.5 trillion in the annual investment gap. And this gap has likely gotten a little bit worse during the pandemic period, where private capital has exited developing countries and domestic spending has been diverted to emergency responses associated with the pandemic. So we expect and we believe that the financing gaps are substantially higher in emerging markets than in developing countries when compared to advanced economies, because the majority of the emerging markets have very limited or non-existent public markets. And where they do exist, most of them are likely small and provide access to only a few large banks and corporations, and thus rely heavily on private debt and equity capital market as funding sources. At the root of the sustainability challenge lies lower levels of transparency and governance standards. And I think all of my colleagues have pretty much touched on this particular topic. And where these are lacking, integrating ESG criteria in investment decision-making would likely be a challenge as well. We see a weak corporate governance framework results in ineffectiveness at the level of the board of directors. It limits oversight and control systems. It lowers transparency and accountability, and heightens informational asymmetry and conflicts of interest. This is where we believe that a robust and sound corporate governance framework is at the heart of making institutions stronger, more efficient, highly and more readily accountable, and supports the implementation of good environmental and social practices. Well-governed entities will be better positioned to mitigate risks as well as safeguard against mismanagement while attracting investment and managing resources, and safeguard against conflicts of interest and improve sustainability, while enhancing stakeholder value and helping companies resolve environmental and social issues. IDB Invest believes that the appropriate governance standards and systems are crucial to success. By working directly with varied companies and clients throughout the region, our organization helps firms to adopt good corporate governance standards and practices that meet internationally recognized standards. And with greater transparency and informational symmetry, larger capital flows do ensue. While it is critical to achieve sustainable economic transition, we believe that targeted capital to specific purposes is better able to align scarce financial resources and optimize risks associated with that, and help close the financing gap with flows that prioritize the sustainability agenda and provide environmental and social positive impacts. So in aggregate, we believe that IDB Invest is firmly along the right path where ESG objectives and greater opportunities of success can occur, where financial resources are combined with technical advisory support to create positive impact. And by combining internal capital with third-party blended resources where necessary, coupled with mobilization and third-party funding that is targeted, action-oriented technical advisory support, in inclusion, clients are better able to achieve better and enhanced ESG performance. But to achieve this mandate, we believe that the product solution set involves a myriad of financial structures and instruments that are very key and speak directly to sustainability. IDB Invest has pioneered what are known in the market now as sustainability-linked bonds and loans, outcome-based financing options that are all geared to quantitatively measure impact. Other structures that we have been working with clients throughout the region on are subordinate structures, as well as equity in some cases. Even at the shorter end of the tenor spectrum, resources are also geared towards promoting trade opportunities alongside sustainability themes. This, we believe, with proper pools of blended funding resources being available in nascent markets, help drive the opportunities towards bankable projects. Under this approach, we have seen ESG performance move creditably in the right direction. Within the last 5 years, IDB Invest has been able to drive sustainability across the region by advancing the climate agenda, improving access to finance to SMEs, supporting and enhancing gender diversity and inclusion with continuous monitoring and transparency disclosures to all of our stakeholders. So, in summary, what I'd like to mention is that IDB is strident in encouraging private sector participation in sustainable financing by attracting more players to the sustainability table. Since 2017, IDB Invest has supported the issuance of over 20 thematic bond issuances, valued at over $1.3 billion, which includes the mobilization of easily $500 million in private capital. This volume only represents about 10% of the thematic bond market in Latin America and the Caribbean by volume, and about half the number of thematic bonds issued to date in the region. IDB Invest has long supported first of its kind transactions, including the first gender bond in Latin America, the first social bond in Brazil, and the first gender-linked bond based on achieving particular outcomes. IDB Invest in and of itself has launched a US $1 billion inaugural sustainable bond in February of this year to support economic recovery within the region, followed by its first local gender bond issuance in Mexico. So with that, what I would like to do is throw it back over to Jose and thank him very much for having me here this morning. I'd like to encourage everyone here and even within your respective organizations to join us in improving their lives throughout Latin America and the Caribbean region as we journey along this path of sustainability. Thank you very much, everyone. And I'm looking forward to the discussion during the panel presentation.
Thank you very much, Stephen. Well, right now, I would like to open the Q&A or the discussion of the panel. And I would like to start with something that has been around recently. There has been a lot of criticism or pushback regarding ESG globally, especially in the developed markets. Elon Musk a few weeks ago, quoted that ESG was a scam when after Tesla was removed out of the ESG S&P ESG index. There has been also some boycotts from politicians in some states in the US, banning large firms like BlackRock or JP Morgan that are large advocates of ESG investing, irresponsible investment, and probably as a response of lack of investment in some of large I would say, non-friendly ESG industries like fossil fuels in Texas, as an example. And also, I've been reading also about some active shareholders, large shareholders in annual meetings, pressing for or voting against ESG initiatives from the companies, public listed companies, no? So do you think there is a merit on that pushback that we have seen recently regarding ESG? I would like, to open a discussion and all of you who want to comment on that.
Well, don't pick an easy question, Jose, to get us going. I think part of the pushback is political and just political agendas diverging, which is a big part of that, I do believe. But I think part of it is also this conflation of ESG and putting in place practices that mitigate environmental, social, or governance risks with, are you creating environmental impact, right? Like, are you reducing greenhouse gases? Are you, and I think that they can be one and the same, but I don't think that they necessarily are. And so I think that that helps to fuel frustration about what is and what is not. And I think that that is part of the reason why global standards are so important. And, for what it's worth, like, we know that the SEC in the US is starting to think about what might US regulation look like around ESG. And one of the conversations that we've had with a number of other industry players is really helping to disaggregate ESG from impact creation in order to limit some of that conflation and confusion.
I'll pile on because I agree with a lot of what Allison has said. I think this is, kind of part of the root cause is, as she said, conflation. And it's because in this newly evolving area, I think a lot of new techniques have evolved and a lot of new terminology has evolved. There hasn't been standards around those definitions. So it creates this environment that is ripe for misunderstanding. And the examples you gave, I think, are excellent examples of misunderstanding. That Elon Musk is upset because he thinks that these ESG indices should give him lots of credit for creating a more sustainable product. And there are certain indices or rating systems that would do that, right? But what he misunderstood, I think, is that the index in question was looking more at a broader set of factors, like the environmental impact and the social impacts of Tesla Corporation broadly. And also with some of the political pushback, particularly here in the States, I think it's about the politics of allocating capital. And we see this in Europe too. I think we saw, there was a big debate in Europe over whether nuclear should be part of the EU taxonomy for sustainability. And if it is, that's going to direct capital flows to some countries and some industries, and it's going to direct it away from others. So anytime you've got some influence in the system that's directing capital, I think you're probably going to get into some politics. And maybe lastly, I want to say also here in the United States is concern about the primacy of risk and return. And particularly pooled funds, where maybe investors' capital is being used for ends that those investors might not agree with. And with respect to pooled funds, where people have the choice to invest, I think that's less of an issue. Where this comes up more often is state-level public pension funds, where teachers and firefighters are part of the pension system. They don't have as much option about where to invest. So these are creations of individual states, and thus they make rules about how those pensions need to behave. But I also think in places they go too far, they also misunderstand that, actually considering material ESG issues can help with risk and return. And they're sort of lumping everything together. So we need to continue to strive for more accuracy and precision when it comes to discussion and communication of these important topics.
I would like to add to all the answers that we have received that I completely agree with all of them. It's transparency is key in financial markets, especially when it comes to ESG. No, so just grabbing this example of Tesla, I have to say that all the methodologies that we use are public. Even not just for the index construction side, but also for how we are capturing at S&P Global the ESG scores. No, and for example, in the case of Tesla, there may be some confusion because they are very active on EV, no, in the electric vehicles. So, however, that's not the only thing that we are evaluating in S&P Global. As an ESG score, of course, we have to measure as well social aspects. Even within the environmental aspects, there are more criteria that are involved, even involved in these scores, and they have different weightings depending on the impact that they have in the financial materiality and also the reputational materiality. You know, it's this double materiality that Alison was talking about before. No. So in this case, the methodology, the index methodology, it's stating that we first need to, after some screens on product involvement, there's another screen that we are removing the worst 25% of the geeks industry group around the world. And in this case, unfortunately, Tesla fell in that group, no? So it was not even eligible to be part of the index. So what I think it's a little bit confusing probably for the market, it's that even when we have all this transparency, is that there are different methodologies out there, no? All of them probably transparent, or most of them, the most serious, transparent and public. And they're targeting different things, no? So these, not all of them are highly correlated. We may have different results in terms of ESG scores, but the thing is that we need to provide this transparency. In our case, we are able to showcase the weights that are assigned to the different criteria that are driving to the dimensions and then finally to the score, and what are the answers of the companies. No, so this kind of transparency supports like the strategy itself. No.
I'd probably also add to what everyone is saying is that you know, we tend to see the world through our own particular lens, whether it's investment or personal. And so we each have our own individual, sometimes blinkered approach to how we view the world. And I think that's also playing out in a lot of what we're seeing today with respect to ESG. So I think as the world moves towards some convergence of sustainability and ESG standards, you're going to have these disruptive movements from time to time where people are dropping one standard in favor of another. And I think that's fine because as long as we move in the right direction, we will get there over time. But I think having the disruption is good for the markets in that we get what is hopefully the most optimal and the best standards over time. And I think Chris would probably agree to that. So I think it's important that we have this information discourse that ultimately will lead to better decision making for, I think, everyone in the audience here from a portfolio management, as well as from a banker that's helping an issuer come to market with respect to a particular issuance and opportunity.
Thank you all. I'll start with some questions specifically for each of you. We're starting to receive some questions from the audience. I'll start with you, Stephen. There's a specific question. It says, what could be a procedure for a Peruvian company or a Latin American company to raise ESG funds through IDB Invest Advisor?
Sure. I think the first place to start is literally calling the country office in Peru and sharing your ideas. I think once you share the idea with us, what we're able to do, and it would help to know which particular industry that this particular question is coming from. But I think having that honest early conversation about what your strategy is and what your approach is likely to be, we have two arms: an advisory arm that can literally come in and guide you through that process to issuance or fundraising, see where the gaps are, and over time begin to close those opportunities alongside providing with funding. So I think the funding is almost the easier side, because I think funding sources are easily obtained, depending as long as you can define use of proceeds. But the challenge is the technical support or the technical assistance that's required to show that the funds are going to a particular purpose. And the way we do that is at inception or deal close, we benchmark or baseline where you are now in that particular environment or that particular aspect of ESG. And then during the life of the financing, we measure the level of impact or the level of success you've been able to achieve along the path. And where there are deviations from that particular path, we invite discussion and we reassess for future alignment as we go forward. So I think having that discussion and seeing where that impact is likely to come from is a good place to start. And I welcome, calling the Peruvian office and having that early discussion with the private sector team.
Thanks, Stephen. I have a question for Maria. Considering that we are in Latin America and the Caribbean, what are the main challenges for the generation of indices, specifically ESG indices in the region? I'm thinking about, I'm Peruvian, so I've seen the experience in Peru, and maybe how strict the eligibility criteria, the number of companies that are very limited, and how far are our markets from reaching the best-in-class standards globally. How do you face those challenges in the region, Maria?
Yeah, so even without the ESG layer, we have a lot of challenges creating indices because of the universe size, as you will said, and also Stefan mentioned that in his presentation, and also the liquidity. No, so for example, applying our baseline methodologies into the country level, it's not always possible. No, for example, trying to apply sector neutrality when you may have just one company representing the sector may not be a big differentiator on creating a specific strategy, including ESG, no? So the size and the liquidity, it's a challenge. And initially, of course, the coverage, no, for ESG data. So, for example, for the ESG scores, they initially invited universe to complete the corporate sustainability assessment that was initially run by SAM, now it's S&P Global. It was covering the Dow Jones Sustainability Universe. And over the time, we have been including more like small country universes, including Brazil General. No? So for the ESG score now, we have a super big percentage of the members of the Peru General covered, like 99 or even 10% of the companies. However, it's S&P Global, it's not the only vendor that we have, no? So we still lacking coverage of some other vendors that prevent some of the companies to be part of the index, no? So there are two main things in terms of eligibility and also how we apply the strategy. We have to make some ad hoc decisions aligned with what are the requirements from the exchange and the market participants to target these local markets. And in terms also for the demand, no? So what we have seen is that the adoption of passive solutions in Latin America for foreign exposure, it's been very welcome, no? For a lot of years. And the passive solutions focus on the local markets. It's more like we have a slower adoption, no? So that's another thing and that it's I think preventing the explosion of indexing or passive solutions in the region.
Thanks, Maria. I will jump to Chris. I have a question here. What is the biggest hurdle facing firms who want to comply with the ESG standards? And regarding that, I'm thinking about a fund manager, no, who also, by any chance, needs to report to other like PRI or TCFD or even Latin American companies that haven't even implemented other reporting standards like GIPS, no? They are not even at that level, and then now they have to think about ESG codes or standards, no? How do you see this problem?
Yeah, the main thing we've heard from managers is resources or lack of resources to do all the things that they need to do. Particularly when it comes to disclosures, a lot of managers are facing new regulations, and understandably they say, well, you know, we'd love to comply with these global voluntary standards, but compliance comes first, and that's completely understandable. And to those people I say, you know, I hope you use the global ESG disclosure standards then as a tool while you're preparing your regulatory disclosures. And you know, things like GIPS and these standards are tools. They're actually tools for managers to use that can make their job easier. Because imagine if you didn't have things like the GIPS standards, then not only would you be trying to do all the calculations and create the reports, but you'd be figuring out, well, how should we even do these calculations and what's acceptable, you know, what's standardized. So in tackling some of those questions about how performance should be calculated, what sort of information should be presented and disclosed to prospective investors, that actually does take some of the burden off of managers as they try and go about running their business.
Jose, I would just add on, so we are a fund manager, and I think that leveraging existing tools and standards has become very helpful as we report into regulators around compliance issues, in part because what we're hoping is that it sets a baseline of saying, these are the standards that we're using, and here's how we come out, and here's how we incorporate them into our own due diligence. Helps us leapfrog over the conversation of, well, let me first define what the standard is. Let me explain to you why it's important. Let me explain to you that there's credibility and that others believe it's important as well. And now, okay, let me tell you how I'm going to use it. So it does facilitate that process, I think.
Yes, of course. Thanks, Alison. And I have a question for you specifically right now that you have your mic open. Your SIM is specialized on impact investment, correct?
Yes.
And could you probably tell the audience what are the main differences between impact investing and ESG? And if in terms of returns, does impact investment incorporates the idea of not necessarily achieving market returns? You're leaving some of those returns on the table just to have the ideal outcome or your purpose as a firm.
So that's a great question. And maybe I'll break it up into a couple sections. So I would say, I would propose that impact investing is intentional about the change it's looking to create, and that there are metrics around how are you going to get to that change. And it's oftentimes a process, right? So it may not be one investment and you're going to achieve the impact that you're ultimately trying to get, but you do see the journey and are quite intentional and deliberate about measuring that outcome. Compared to ESG investment, which I think can sometimes be on the sort of lighter side, can be just a no investing in areas that you think are negative, so a negative screen, all the way through to ensuring that there's certain policies and practices that fit within each of the ESG categories that you believe are important for risk mitigation and for the longevity and the ultimate success of the business over the long term. So I do think that they're distinct in that way. Certainly one can incorporate the other and vice versa, but I think that they start with a very different initial proposal as to what they're trying to do. In terms of your second part of the question of, does impact investing necessarily mean that you're sacrificing return? Honestly, that's a hard question to answer. I think that there's a spectrum, and there's certainly investors that are more impact first, and then there's investors that are more commercial, but still believe that at the core of what they're doing, there is intentionality around that positive change. And so I think it can be both. I think, you know, if you're a potential LP and you're looking at funds, it's asking yourself, what sort of risk-adjusted returns do you need? And do you believe that the impact thesis and the metrics that the particular fund manager is showing, as well as their approach to integrating impact into the investment decision process, makes sense? And I think if you can say yes to those things, then you get to a point of that happy balance of whether you're a little bit more impact focused or you're a little bit more commercial focused, but either way, you see where that balance is achieved.
Thanks, Alison. I have a couple of interesting questions here from the audience, and probably this is more for you, Alison, because you see me specializes in probably in early stage companies or startups, but any of you feel free to jump and complement. How do you foresee small companies and startups being able to comply with new ESG controls and internal governance systems that may need to put in place in order to get funding?
Yeah, no, it's a hard question because we work with fintechs. Some can be, you know, fairly mature, certainly have staff that are in the couple hundreds, but we also work with fintechs that are really new, that have a proof of concept and may have 30 employees. So if you think about, if you just sort of randomly pick an ESG policy, human rights framework, right? Like you want a human rights policy, you want sort of anti-slavery policy, but does that make sense if you have 30 of your, you know, friends sitting at the table, sort of bootstrapping a company together? It kind of becomes silly. That said, because we're a debt provider, oftentimes founders want to come in because they don't want to dilute their ownership quite yet, and they're hoping to build out their company, get a better valuation, and then raise more capital. We know that as you want to raise more capital, the expectations and the sophistication of those expectations from investors also increase with the amount of money you want. So sure, today, it may be silly to think about a human rights policy, but as your valuation goes up and you're attracting a variety of more institutional investors coming in, they're going to start to demand those things. And so the question, I think, is when is that right time to start putting those into place? And I don't know if we have the answer to that. We work with a variety of different fintechs, and some are super open to saying, let's just create those things now and we can figure out how to put them into practice as they become more and more relevant. And others that are like, ooh, it's a little too early for us. Like we have a gazillion things of just trying to get our product to market. This doesn't fall high on the priority list. So I don't know if there's a good answer, but we do see it as a journey. And at least for ourselves, we believe that we can help along that journey at the right times when our partners are asking us for that assistance.
Thanks, Alison. I have another interesting question from the audience, probably more suitable for Stephen, but anyone who wants to jump on it. It's how political noise in a country could affect ESG. This is especially interesting for a Latin America and a Caribbean region, no?
Yeah, story of our lives. I don't think we can escape the political noise that goes with much of our lives. I think it's just a natural happenstance from that point of view. So the challenge is to understand it, mitigate it where possible, and minimize it to the point where it doesn't materially impact. I think what's important is whatever the project is looking at, whether it's Latin America or another part of the world, I think the engagement and dialogue that you have up front is meaningfully critical to ensuring that projects do see a successful completion, particularly where, as I would have mentioned in my presentation, that governments have a stronger hand at the evolution or some commercial aspects of the economies within the region. So take, for example, in the Caribbean region, governments do have a heavy hand and they drive the economy in most of the Caribbean countries forward, where the private sector is still taking time to come up to speed. So that dialogue upfront is required to ensure that there is commonality and focus in achieving certain objectives. I think what also happens as well is an organization such as the IDB or another multilateral bank. I don't want to basically say that we're the only one in the room, but having other multilateral players that see the world beyond just a singular country focus can be an honest broker sometimes to both the client as well as the public sector in driving change and showing where there are opportunities for collaboration, for consensus, and dialogue to achieve certain balances. So I think that it's important. It's clearly necessary to mitigate where they're concerned, but governments do represent a particular voice, particularly where you have in some societies disadvantaged or affected persons that through migratory patterns or indigenous populations, it's necessary to hear that voice. And that not be at the expense of commercial or corporate decision making, but it's a balance.
Thanks, Stephen. Maria, could you elaborate on help us understand the corporate sustainability assessment process, and why do you think it's important for a company to participate in the CSA?
Sure. So the corporate sustainability assessment is the way that we are capturing in S&P Global how we get the information from the companies to get an ESG score. So it's not run by S&P Dow Jones Indices. It's run by Sustainable One, that it's part also of S&P Global. No. So when we talk about the CSA, we talk about the questionnaire or the methodology, no? But it's not just one questionnaire. We have actually 61 questionnaires, depending on the industry that S1 is identifying. And this is very important because not all the things that are relevant or from financially impact or this double materiality for one industry are really relevant for others. In this corporate sustainability assessment, we identify what are the components or the questions that we are requiring to be really public, and there are other questions that it's like information that we would like to have, but it's not necessarily public. So you may have different questions, and those questions are especially for these 61 industries. And then we compile them into criteria. No, the way they are compiled, it's like a weighted average, where the weight it's given by this, but by the probability of impact and also the magnitude of that impact. No, we run these questionnaires once per year. So we start with the invited companies, and that as I told before, we are inviting companies of different universes. In Latin America, we are considering, for example, Total Mexico index, that it's a broad index for Mexico, also a broad index for Chile, another broad index for Peru. So we are trying to be more and more inclusive. And even if the companies that are invited, they decide not to answer, if they are invited, they get a score, no? And This is important because as an index provider or a rating provider, we don't have this the proxy voting approach that an asset manager has. But for us, this is CSA is a way for engagement, no? Because we have this continued communication and kind of guidance to the companies. And we have received, in terms of why it is important for the companies, in our recent visits to Latin America, especially to Peru, we have received some comments from the companies participating in the CSA, and they mentioned that this is like for them a self-assessment and a guidance of what's going to be required over the time. The methodologies change every year, trying to incorporate these new requirements. Now, for example, in the last year, we had the TCFD, and that's a very important approach for the companies because they are able now to identify, not because we said that, but it's because we're incorporating something that in the globe they are telling us that it's important, risk and opportunities, no, and how they can identify and mitigate the risk that Alonso and Christopher were telling before, no?
Thank you, Maria. And another question for Chris. What resources does the CFA Institute provide to help firms who want to comply with the ESG standards?
We provide a number of tools. Let me start with, we offer an optional template that helps people standardize the format and structure of their ESG disclosures. So managers are free to use whatever format they want, but this template will feel more like a due diligence questionnaire and help them determine which requirements are applicable for their product. Could also help the people that they give it to perhaps better understand the disclosures. We offer a technical handbook that explains the requirements and gives more sample disclosures. And that I think is a real value, because often when managers have to respond to regulatory requirements or due diligence questionnaires and the questions or requirements are vague, there's no resource to go to. It's hard to get answers for, from a regulator. Well, what did you mean by this? And that's where the handbook is particularly useful. We have a help desk where people can ask questions about, what we meant, work through examples. We're even offering to give people feedback on draft ESG disclosure statements to, again, help them through their first disclosure statements, and then they can take those learnings and apply it to other products. We also have a couple of translations into other languages. We have some cross-references available for particular regulations. So we have a lot of tools and resources, and they're all on one web page. They're easy to find. Actually, if you just Googled or searched for CFA Institute ESG disclosure standards, you will find the page and you will find all those resources.
Thanks a lot, Chris. I have one final question from the audience that I believe could be answered from by any of our panelists, because of it could be answered by could take different angles here. How important are the voluntary corporate governance codes now common in the region to institutions forming an ESG judgment about a company? Please feel free to jump in and start a discussion on this.
So I'm not super familiar with the regulatory guidance in Latin America and the Caribbean. I'm probably most familiar with what the European Union has been doing. I think it is fair to say that while it's very new and everyone's trying to figure it out, from attracting capital, that becomes very, your designation within the SFDR can become quite important, in part because our understanding of it is that it really pushes from, it follows the money, basically, right? So an investor into CIM investing into fintechs investing or lending to underserved communities. The structure of the SFDR is to try to understand where the changes sort of across that supply chain. And so it has become quite important. That said, it's also really new. So let's see how it plays out.
Thanks, Alison. Anyone else want to comment on that? Okay, so we need to wrap up now. I'll leave you with Inigo Bengoechea for the closing remarks. Inigo is from the CFA Institute in Latin America. Thank you all for participating in this panel, and thank you, Inigo.
Thank you, Jose, and let me now give the closing remarks. I'm Inigo Bengoechea, and I'm the Senior Director for Government Relations at CFA Institute. Thanks to everyone who participated in our ESG Investment Outlook webinar for Latin America and the Caribbean. And special thanks to all of our speakers today, Eduardo Atertua from Principles for Responsible Investing, Maria Sanchez from S&P Global, Alison Eskesen from Community Investment Managers, Stephen Thomas from IDV Invest, Jose Larrabure from CFA Society Peru, Christopher Fielder from CFA Institute, and the chairman of the Advocacy Council, Melvin Escudero. Their insights were very much appreciated. So if you will allow me to put emphasis in one of the aspects that was discussed today, is that ESG integration in many countries in Latin America and the Caribbean is a reality today and is here to stay. And the region is moving in that direction and is closing the gap, thanks to government and regulatory support, as well as industry adoption. I think we can all be proud that the region is showing that its integration is happening both on the public sector and private sectors. And so ESG integration is clearly proving to help increase returns, mitigate risk, and is appealing to a new generation of investors. The region, though, faces challenges when it comes to its journey around ESG, and one of those challenges, we discussed it at length, is greenwashing. And we must remain vigilant as a group that this practice continues to be challenged, so we don't reduce the legitimacy of the work that is being done. CFA Institute's ESG standard can help with that. The second is financial capacity building. We have to raise the standards of knowledge around ESG in the region. And for that, let me remind you again about CFA Institute's ESG certificate that can help with that as well. Finally, let me say that this webinar is a collaboration amongst 13 societies in the region. Without them coming together, this webinar would not be a reality. And therefore, my sincere congratulations to all the volunteers, and especially to Hugh Miller and Melvin Escudero, our chair and vice chair of the Advocacy Council. We do have other webinars coming up, so please stay tuned as we bring you high quality speakers, industry leaders that can speak to those trends that are happening in investment management. Thank you for your time today. Pleasure to see you and have you, and look forward to seeing you soon. Have a good afternoon.